Because decision makers require information for relatively short periods of time, monthly, quarterly, annual periods, we use GAAP, accrual basis accounting. And under accrual basis accounting, we record revenues in the period in which we perform the service or deliver the goods, and then we record costs as expenses in the periods in which they have generated the revenues. This brings us to the issue of adjusting entries. When we're ready to prepare financial statements, let's say here at the end of 2018, we need to record adjusting entries to make sure that we've recorded the revenues and expenses in the proper period of time. In other words, 2019 expenses will be recorded in 2019, 2018 will be recorded in 2018, and we want to make sure that we record properly all of our assets, liabilities, and equity as of that balance sheet date, that point in time. So our adjusting entries are going to ensure that we record revenues and expenses in the proper period of time, and at the same time will ensure that we record the proper amount for assets and liabilities on our balance sheet. Let's go ahead and take a look at some adjusting entries. We've got two broad types, deferrals and accruals. Deferrals, notice, are where we incur an expense. We pay cash before we actually incur the expense. In other words, before we generate revenues with that expenditure. Unearned revenues are when we collect cash from a customer prior to performing the service or delivering the goods. Accruals are just the opposite. Accruals, we've provided the service, but we have not yet billed or collected cash. And accrued expenses, we've incurred the cost and it's been used to generate revenues, but we have not yet paid or recorded that cost. Another way we can look at adjusting entries instead of as deferrals or accruals, I like to look at them in terms of adjusting entries that all firms will have, and all firms will have adjusting entries that relate to the use of an asset or an unrecorded liability and expense. And one thing we notice about adjusting entries immediately is they always involve at least one balance sheet account and something on the income statement. So all of our adjusting entries will include a revenue and expense account and then something on the balance sheet. And again, all firms will have adjusting entries that involve the use of an asset and an unrecorded liability or expense. Let's go ahead and look at some that would involve the use of an asset. The first might include expiration of prepaid expense, prepaid rent. We've paid rent in advance for a certain period of time. As that time passes by, the rent expires and we record a decrease in the asset and rent expense. The same thing is with insurance. Typically we pay our insurance up front, maybe 3 months, 6 months, or a year in advance. We have an asset. As time goes by, that insurance expires as we use it to generate revenues. We record at the end of the year a decrease in that asset and insurance expense. If we've purchased supplies ahead of time and recorded them as an asset, over the course of the year, as we use those supplies, our asset decreases and we record an increase in supply expense. We can even go so far as think about plant, property, and equipment. It's a decrease in assets and we're recording depreciation expense. So all firms will have situations in adjusting entries that involve a decrease in assets and an increase in expenses. And think about the similarities between these. The next broad type that firms was unrecorded liabilities or expenses. At year end, typically we owe our employees some salary or wages. So we need to record a liability for wages payable or salaries payable and an expense, salaries expense. So we had an increase in liabilities and an increase in expense. If we offer a warranty obligation on our products, at the end of the year, we probably have an outstanding warranty obligation or a liability, and we will record a warranty expense. Again, we recorded the sales in the most recent period. We want to record that warranty expense in the same period. If we've borrowed money in the past year, likelihood is at the end of the year we owe interest expense and we'll need to record interest payable. Same thing with utilities. We typically pay that after the fact. So at year end, we have an unrecorded liability we need to record, utilities payable, and we're going to record utilities expense. So again, all firms have these types of adjusting entries that involve the use of an asset or recording of a liability and an expense. The other types of adjusting entries aren't quite as common. They involve recording an unbilled revenue or recording a revenue for something we previously recorded as an unearned revenue. Unbilled revenues typically happen for firms that earn their revenues over time. Think of a utility company. As you're using electricity, they're providing a service. And at year end, if they haven't billed you, they have a revenue and some sort of an unbilled receivable or an asset. Your cell phone provider would be another example of a type of firm that typically at year end will have an unrecorded revenue and an unrecorded receivable of some sort. The next type are the ones where customers have paid up front. We've talked about that in the form of Millersville University. They collect tuition up front and they record a liability. Over time, that liability does what? Decreases as they provide a service. So at year end, the likelihood is that they've provided a service and will have a revenue, and they will decrease their unearned liabilities. Another example, when you paid your insurance bill up front, the insurance company had a liability, unearned insurance revenue. Over time, as they're providing that service, they need to record a revenue and decrease that expense. Those are the types of adjusting entries we'll make at year end. Let's go ahead and look at some basic adjusting entries. Record the expiration of prepaid rent. We have a decrease in assets and an increase in expenses. And of course, that will decrease our profit margin. Record an estimated warranty liability. We need to record that liability, an increase in liabilities, and the associated expense. And notice, we made the sale in the last period of time. We provided a warranty, so we recorded a revenue. We need to record the associated expense in the same period. Recording depreciation expense. Again, this is the decrease in an asset and an increase in expenses. And of course, whenever we're increasing expenses, we are decreasing our profit margin. Estimated tax liability, $4,000. Typically, we're not paying our taxes until after the end of the year, but the tax payment we make on April 15th related to the prior year. So at year end, we need to record an estimated liability and record an expense. Record estimated bad debt expense. If we make sales on credit, we're going to probably have bad debt expense, so we want to record the expense in the same period we made the sale, and we record a decrease in assets in the form of that allowance for doubtful accounts. And again, all of these involved increases in expenses, so we have a decrease in our profit margin. Let's go ahead and look at office supplies. Currently, our books say we have $1,500 of office supplies on hand, but we go into account and observe that there's really only $200 of office supplies on hand. So obviously we need to decrease our assets, and we're going to record an expense, supply expense. And that again will decrease our profit margin. Salaries earned by employees not yet paid or recorded. So again, December 31st, we probably owe our employees something, so we need to record an increase in liabilities, salaries or wages payable, and an increase in expenses. And again, as expenses go up, our profit margin goes down. Unearned revenue. Our account shows that we have a balance of $1,500. So in other words, we owe our customers $1,500 in service. But in reality, only $500 remains unearned. So we have to reduce our liabilities, and we are going to, in this case, record an increase in revenues. And again, that increase in revenues will cause net income to go up, which makes our profit margin increase, and that will have increased retained earnings and keeping our balance sheet in balance. Record the estimated interest on notes payable. Payable means we have a liability. So we owe interest. We're going to record interest expense and some sort of liability, interest payable. As expenses go up, our profit margin decreases. Recording interest on notes receivable. This is an asset, so we're earning interest revenue. At year end, if we haven't recorded or received that interest revenue, we're going to record an increase in revenues because we earned the revenue during the most recent year, and we're going to have some sort of receivable or asset, and that of course will increase our profit margin. Now I want to dig a little further and examine the impact of adjusting entries not only on our profit margin, which was net income divided by sales, but also on our current ratio, which is what? Current assets divided by current liabilities, or our asset turnover, which was a measure of how efficient we are using our assets to generate sales, and that's simply sales over assets. So let's look at our first one. We've credited interest income, so revenues went up. And what's the other half of this? It sounds like we would have probably debited what? Unearned revenue. So our current liabilities go down and we have a revenue. That revenue will increase net income. It will increase sales as well. But of course, that increase in net income will be greater than the overall increase in sales from a percentage perspective. So we will have an increase in our profit margin. Current ratio. There's no change to current assets, but there is a decrease in current liabilities. So if current liabilities get smaller, overall, our current ratio will increase. We had no change in assets, but sales increased. So our asset turnover will also increase. If we had a credit to prepaid rent, the other half, so assets went down, the other half would have been what? Recording an expense. So rent expense. Of course, this would have made net income go down. Net income goes down, we would have had a decrease in our profit margin. Prepaid rent is a current asset. And as current assets go down, our denominator or our numerator goes down, so our current ratio decreases. We had no change in sales, but a decrease in assets. So overall, this fraction gets larger and we have an increase in asset turnover. Let's take a look. Next one, credit interest payable. Liabilities go up. We obviously did what? We recorded interest expense. In terms of our accounting equation, the expense does what? It decreases net income, so our profit margin will go down. We had no change in current assets, but interest payable will be a current liability. As current liabilities increase, our current ratio decreases. We had no change in sales. We had no change in assets. So we will have no change in our asset turnover. Next one, we record a debit to bad debt expense and a credit to our allowance for doubtful accounts for receivables we don't expect to collect at year end. So let's go ahead and look and see how that impacts us. Again, the expense will cause net income or our profit margin to decrease. In terms of our allowance for doubtful accounts, that decreases our net receivables, which are current assets. So as the numerator gets smaller, there's been no change in liabilities. We've got a decrease in our current ratio. Again, the allowance for doubtful accounts decreases overall assets. We've had no change in sales. So if assets goes down, overall our turnover will increase. The debit to warranty expense, the other half of that is going to be what? A credit to warranty obligations or warranty liabilities. Of course, the increase in expense decreases our net income or our overall profit margin. The warranty obligation is going to be a current liability. We've had no change in current assets. So as our denominator gets bigger, overall our current ratio will decrease. We had no change in sales, and we had no change in assets. So no change in our asset turnover. Debit to unearned revenue. Unearned revenue is a liability, and of course that debit made it go down. The other half of this is what? We've recorded a revenue, so we performed a service. So we're going to credit revenues. Of course, that overall increase in revenues or sales will increase our net income, which means we're going to have an increase in our profit margin. We've had no change in current assets, but unearned revenues, a liability, went down. So as the denominator goes down, the whole current ratio does what? It increases. We had no change in assets, but sales, the numerator, increased. So we have an increase in asset turnover. We debit salaries expense, which means we're going to credit wages payable, salaries payable, some sort of liability. The increase in expenses will decrease our profit margin. We have no change in current assets, but current liabilities have gone up, so our current ratio will decrease. We had no change in sales, and we had no change in assets, so we've got no change in our asset turnover. Credit accumulated depreciation. The other half of that would have been what? Depreciation expense. The increase in expense, of course, decreases our profit margin. In terms of our current ratio, nothing's going on. We had no change in current assets because, remember, equipment or anything we're going to depreciate is a long-term asset. No change in current liabilities, so no change in our current ratio. But we did have what? A decrease in assets, so our overall asset turnover will increase. Credit interest payable. We've increased the liability, which means the other half would have been what? A debit to interest expense. As interest expense increases, our net income or profit margin will decrease. Interest payable. That's something we're going to owe within the next year. So we had an increase in current liabilities, and we will have a decrease in our current ratio. We had no change in sales or no change in assets, so no change in our asset turnover. Debit unbilled receivable. So this is an asset. It's sort of like accounts receivable, but we just haven't sent an invoice yet. So obviously we've done what? We've provided some sort of service, but we have not yet sent out a bill. Typically this will be for, say, interest receivable on a note. But we will credit revenues of some sort. So we had an increase in revenues and an increase in assets. So revenues increase, that will ultimately lead to an increase in our net income and our profit margin. So increase. Unbilled receivables, this is likely that someone's going to owe this money to us in less than a year. So our current assets have increased, which will increase our current ratio. And both sales over assets, both of these have increased. But generally, we have more in the way of sales. Let's consider the number 4 in sales for every dollar in assets. So if both of these went up by 1 to 5 and 2, what just happened? Our asset turnover would have decreased. Now, of course, if our original asset turnover had been 1/4, it would be just the opposite. But typically firms generate more in the way of sales than they have in assets. You're going to want to make sure that you can think through these types of adjusting entries and their impact on various financial ratios.